today we are talking about quick tips for maximizing credit scores. That seems pretty important, right, Sam?
Absolutely. And pretty necessary a lot of time.
Yeah, definitely. So I wanted to kind of start this off with what I see from the mortgage side. You don't have to do credit restoration or credit repair or credit best practices just to qualify for a home. A lot of times there are situations where you're 2 or 3 or 4 or 5 points away from getting a better interest rate or getting a better price or cost to your interest rate. So the way that interest rates work is they're essentially based on 2 things. They're based on the equity, how much equity you have in the property, what you owe compared to what it's worth, and your credit score. And these 2 things together will create what's called, and this is kind of geeky, but they're called loan level price adjustments. And essentially what that means is on the back end, the lender is charging you extra fees for higher risk. Lower credit scores, higher risk translates into higher credit scores. So again, I talk to people about I try to tell people to work with somebody like Sam. I'm always looking for opportunities when time is of the essence. You don't always have a ton of options, but if you're thinking ahead, which is what I hope people are doing when they're watching this video, you're thinking ahead and you're planning 2-3 months out. I want to do something. That's when you want to do this and put yourself in the absolute best situation. So I don't know if this is too vague of a question, Sam, but what's the fastest way for me to improve my credit scores for free? Like I need points. What's the fastest, cheapest way for me to do that?
Yeah, well, so the fastest way sometimes is not the cheapest way. Sometimes it is. But the fastest way is going to be by maximizing or I guess I should say minimizing your balance to limit ratio aspect of your credit scoring algorithm, because that's such a huge chunk of your credit score. 30% is made up basically on, how are you utilizing your credit cards? And a lot of people, unfortunately, have let some of their credit cards get away from them a little bit in terms of, maybe you're at over 50% of the balance to limit ratio or over 30% of the balance to limit ratio. So just by paying down, maybe you have a $500 Best Buy card that's at $350, from your last purchase. By paying that down to $249 out of $500 as opposed to $350 out of $500, you just cross down below that 50% threshold. You're probably going to see a pretty decent increase in credit scores. Definitely single digit points. If you're 4 or 5 points away, that's going to make that difference. And in some cases, like let's say if it was your only credit card or one of your only credit cards, then it's making up a pretty big chunk of your overall balance to limit ratio as well. So just by paying down a small credit card like that,
Does that play into it as well? I just thought of that as you said that. So if I have 3 credit cards and only one of them is maxed out, is that the same or not? Or is that same or different from all 3 credit cards being maxed out? Is it worse to have all 3 maxed out?
Yes.
I guess that's the question. Is it total utilization? So if I have $1,000 balance between 3 cards, are they looking at that total utilization? But you're saying it's both. It's that and the individual balance.
Yeah. So to answer your question, yes, it's a combination of the individual balance to limit ratios and the overall balance to limit ratio. So, on that same theme, let's say that a client had 4 credit cards, right? 3 for $1 and 1 for $4,000. So you got 3 little ones, and then you got your 1 big one. And then and they're all maxed. Let's say they're all maxed. They're all at $999 of 1,000 and $3,999 out of 4,000, and then you came into $3,000. Okay, it would benefit you more because what a lot of people want to do is they want to headhunt for that big one. They want to pay it off because that's the one that's freaking them out the most, right? Because that's a lot of debt. When really you would be better served because no matter what, you're about to pay $3,000 into your overall balance to limit ratio, right? So that's going to change no matter what, because across the board, you have $7,000 worth of credit that's been extended to you, and you're using about $7,000 of it. So we're about to make a $3,000 payment. So that $7,000 is going to go to 4,000 out of 7,000. No matter what you do, no matter where you put it, you're going to end up at 4,000 out of 7,000 on your overall. So now,
which is higher than your 50% that you need to be.
Exactly.
So you want it. Sounds like you want to be strategic about this at this point.
Yes. Yep. So now you want to go to those little ones and look at it and be like, well, what can I get done here? Well, what we know is that you could pay all three of those down to basically $0, and you would still have one maxed out card at 4,000, but
right.
you just went down by 3,000 on your overall, and you took 3 from 100% to 0 or close to it percent of the balance limit ratio. So your credit score is going to be significantly higher.
So smart. And it, you know, when I said free, what you just described, you don't have to pay a professional for this. I mean, knowledge is power, right. And you just empowered everybody that's listening to this. It's not free in the sense that you need to pay down the credit cards. And then there are some mechanisms with your lender, if time is of the essence, that they can do what's called a rapid rescore. Those costs actually cannot be they cannot be forwarded to the client. The lender has to absorb those, but just these best practices. So yeah, that's really, really smart. I never even really thought about that. So now what about consolidating? I've heard of that. What if I consolidate all of those credit cards and put them onto one? Is there a play there, or does that not make sense?
No, so it would be the same basic premise. Let's say that 3 of your credit cards, the small ones are all maxed out, but you have nothing on the big card. I would rather transfer all those small balances to the big card, have 1 maxed out credit card, and then 3 that are great balance to limit ratios. Because again, it's not necessarily about the amount of debt. It's about the ratios. So a $500 credit card that's at $499 is at 100%. A $5,000 credit card that's at $4,999 is at 99%. So it just that part of it doesn't matter. So what you got to do is just play with the balance to limit ratios and know that it's the percentage that the scoring algorithm is really paying attention to, not the dollar amount of debt on those. So you could do 2 things with that. You could do balance transfers to that 1 big credit card and get those 3 other ones in better shape. You could also, if you can open up an installment loan, and you can, I'm not a big believer in trading, debt for debt, but in this situation, to trade bad debt, which is high interest credit card debt that counts so heavily against your score, your credit scores, and to trade that then for an installment debt, which is already factored into the scoring algorithm that you're going to be maxed on it. Because if you think about it, if you go buy a car for $20,000, you get a loan. The scoring algorithm knows that loan's going to be for $20,000. It's fine.
Installment debts, they're scoring you based on on-time payments, not necessarily the balance of installment debt. But whereas credit card, it's you can spend that money. Are you willing to? I've never thought of putting those balances onto installment debt before. I've never personally done that. But as soon as you said that, this light went off in my head, and I was like, that's brilliant. That really, again, it's not a perfect scenario, but it's a smart strategy if you really have to go in there. Now, okay, so those are all good things. Now, what about what should you never do to your credit if you want to maximize your credit scores? What things should you never do?
So you should never go and just start paying off collections. What most people don't realize is that once something goes to collections, basically time. Yeah, exactly. The damage is done. Okay. So what happens is that debt will get older and older and hurt you a little bit less, a little bit less, a little bit less every month, every year. So now, you're going to get financed, or you're thinking about it, and you say, I want to get my ducks in a row. I need to get my scores up. I'm going to pay off those 4 collections from back in 2012 when I was going through a rough time, or 2015, whatever, right? And what you do is you're basically kicking a sleeping dog, waking it up, and the scoring algorithm is keying in on what's called the date of last activity. The date of last activity determines kind of how old an account is. and that's where time can help you. But when you make a payment, it will update the date of last activity to today's date, and basically the credit scoring algorithm, for all intents and purposes, is going to look at that as a new collection hitting your credit, and your scores are going to react the same almost as a brand new collection hitting the credit, and they're going to drop. So you would not want to go out, and I'm not telling people not to make good on their past debts. Don't get me wrong. It's just, if you are trying to increase your credit scores, you need to understand how the algorithm works, and paying off a collection is not going to get you the increase that you think you're going to do. So number one, don't go out and just start paying off collections.
No, I can tell you, automated underwriting systems, Fannie Mae, Freddie Mac, FHA, VA, USDA, almost all of them have gotten really good at dealing with collections and charge-offs. There are ways to do loans without paying off collections. You never have to pay off charge-offs.
Right.
Those are off the books. Those don't even get factored into to your risk model. So yeah, that is a really good one. So don't pay off collections or charge-offs. That's huge.
Yep.
What else?
Yep.
What else might be in there?
Yeah. So one that kind of goes without saying, make sure all your bills are paid on time. Mm-hmm. No new late pays during the mortgage process. That'll kill you. Another one is, don't open up any new accounts unless instructed to, specifically by your mortgage lender or by My Credit Guy if you're working with us. Okay. You can, to kind of reference back to what helps you, sometimes it strategically makes sense to add a new positive trade line, specifically a credit card.
Because if you're lacking trade lines.
Yes, exactly. You're lacking in that area, and either you need to establish it, or we need to make your ratios look better for your overall balanced limit ratio by adding another credit card if you don't have the funds to pay one down. So, but you would never want to, because here's a specific, scenario that happens. Okay, so Joe Schmo goes out, he gets qualified for a home loan at a 645 credit score, starts thinking about this new house that he's going to move into in a month, and what does he want in it? He wants a new couch, and he wants a new TV, and he wants all these things. So he goes to Best Buy, and they say, hey, you know what? Instead of paying cash for this thing, I can get you 5% cash back, or 6 months, no interest. Sign up for this credit card. You sign up for a new credit card. Well, if that TV costs, say, $1,000, they're usually going to approve you for about $1,001, meaning you're going to be maxed on that thing right away. Yeah. And so not only did a new trade line hit credit, which is going to shock the scoring algorithm and cost you points, but now you're also maxed out on that individual balance limit ratio. And let's say that you maybe only had one or two other credit cards and they were smaller. You might have just taken your overall balance limit ratio from being 0% or 10% to over 50% if you open up that new account and have it maxed out right away. So so don't pay off collections, never add new late pays, make sure all your bills are paid on time, and do not open up any new accounts or apply for any new credit during the home loan process, because it can definitely have devastating consequences for you. Yeah,
I've seen that. I've seen that over and over again, and you're absolutely right. Lenders do look at your credit to see if you've acquired new credit, to determine whether you've got additional payments, additional liabilities that are now going to factor in to your qualifying ratios. So that is an absolute huge thing. What I tell people is, you're on financial lockdown. Freeze everything. Once you apply for a mortgage, do not touch your credit, because you do not want any surprises moving forward on that. Now, one of the things, so what we had kind of talked about maximizing your credit scores, and we were talking about moving balances around. What about canceling credit cards? That's a huge no-no, right?
Yeah, honestly, so this kind of goes up to a little bit broader area that you need to pay attention to. Canceling credit cards out, you're not doing anything noble. You're not doing anything great for yourself by canceling out a credit card. You are removing all pay history that you've accumulated on that account, and that all goes out the window like that card never existed. And then you're eliminating any cushion that card provided on your balance limit ratio. So let's say that you had a $1,000 credit card that you're about to close out that was at $0, and then you had a $500 card that was at $400. Okay, so you will go from having $400 out of $1,500 balance to limit ratio, which is pretty good, to having a what would that be, 80% balance to limit ratio once you cancel that one out. So you're going to lose pay history and you're going to lose cushion on your overall balance to limit ratio. So there's multiple ways that thing's dinging you by closing out an account. Same thing though when it comes to the pay history. Like some people will say, oh, I just want to be done with my car loan. I'm going to make an extra payment. During the mortgage process, don't do that. Don't get ahead of yourself and close out an auto loan. And you don't have a choice. If you make the last payment, if you pay off the balance, it's going to automatically close that thing out. And then that's going to eliminate that pay history. So just stay in your lane until you close on that home loan. And then you don't need your credit for a long, long time after that. Then you can start doing some of these things to eliminate debt. But right now, we're worried about home ownership, qualifying, and your credit scores, not necessarily the best debt elimination strategies.
Right. Probably the last thing I would want to throw in here that we're going to cover in a little bit more detail in another video that's very, very common with credit repair scams is they just start disputing everything. When you dispute a credit item, that feature is there in case something is reported inaccurately. But what it seems like ends up happening is they're just like dispute everything. What happens is that temporarily pulls that debt out of the credit scoring model, and it gives you a false credit score. And lenders won't touch it. Lenders won't touch it if you have disputed credit items. So I would add that into one of the things to not do, because if somebody's trying to get a paycheck from you, if you call up Scott's credit scam company and you say, I need my credit score to go up, and I'm like, fine, I'll dispute everything on your credit report. Here, your credit score is higher. I just put you in a world of hurt, because all those things are going to come back because you actually do owe them. And that's just not, that's not a situation you want to be in.
Right.
Okay. So, wow, talking to you about this makes me feel like I have so much more control over my credit scores than what they make what it seems like. Everybody seems like they're just a victim of their credit score. But it seems to me like once you understand this, and once you understand the game and the recipes and all of this stuff, you can really go in there and proactively improve on your credit and build your credit, huh?
Yeah. Once you know, you're exactly right. Once you know the rules of the game, it's just kind of crazy in our country how much credit. I mean, besides money in the bank, there is nothing that has a bigger impact on your financial well-being and your life, in my opinion, than your credit. But we don't get taught about it in high school. We don't get taught in college. And the information we're learning from our parents is probably just as horrible as what we're learning on Facebook when you throw up, a general question about credit and you see all the people with their 570 credit scores chiming in about it. And so, it is important to understand the rules of the game and how the game works. Because if you don't understand the rules of the game, you're running out of bounds, you're throwing forward passes after you're past the line of scrimmage, you're doing all these things that seem, it's like, well, I just thought we were supposed to get the ball to that end. I'm just throwing it. It's like, oh, that's against the rules. You were just never told that. And so now you got a penalty and you're moving backwards, So know the rules of the game.
Man. All right. Well, as always, your advice is invaluable. Appreciate you being on here and sharing this with us. And I look forward to covering more credit type topics with you in the future. Thanks, Sam.
Absolutely. Thank you, sir.
We'll see you next time.
Bye-bye.